Happy Monday. It is November 3rd, and we are going to go through the Monday market update. Got the news you can use. And right now, it's all the ways that we lose. Talking about the big news of the week. What happened last week? We had the Fed meeting, and the Fed meeting was as expected. Fed dropped the prevailing interest rates by 0.25%. But what we did not know was what was Powell going to say. And it has been pretty clear lately that Powell has some very firm thoughts and shared them in the hour-long press conference. It was kind of surprising, even for Powell, who normally is very straight line, doesn't give a lot of information. He made a very pointed stance. And the words he used was, a December rate cut is far from a foregone conclusion. Far from. And he made that a point of emphasis, said it multiple times. It was very, very clear that anticipating a December rate cut is a bad idea. So what does that mean? Well, we got more information from other Fed speakers throughout the week, at the end of the week, and it was all hawkish, which was very surprising. Bostic, Hammock, Logan, everyone late last week was very much along the same lines as Powell, in that they don't necessarily see the signs pointing for a certainty on a December rate cut, that, we had dissents to hold. We had dissents to cut 50 bips instead of 25. The Fed's kind of all over the place right now, and that's not good for having any kind of stability. When you pair that with the lack of data and the lack of data points, it just leads us to a lot of confusion and a lot of overreacting. And that's exactly what's going on. So to sum up last week, Fed cut rates went up. I know we've heard that 5 times in a row now. And, this time is no different. Let's talk about what's going on this week in the wake of what happened at the Fed. It looks like the key points this week, are aligned with things like, PMI and, the manufacturing data. And the ISM manufacturing data is very, very important. It's already out. It came out this morning, and it's pointing to pretty significant depressions in things like commercial vehicle sales are bad. Exports to agriculture, not very good. The tariff trade war is negatively impacting, a lot of things in the agricultural space. Decrease in domestic demand for finished products. Business is strained. Sales are underperforming. All this should lead to improvement in the interest rate market. It's going to lead to some depression in stocks, and stocks did react to it negatively. But why aren't mortgages getting better this morning? Well, you can thank Google for that. Alphabet Inc. Issued a bond sale for about $15 billion in U.S. bonds. So anytime you've got a corporate bond sale that's of significance, that's going to put negative pressure on interest rates. 15 billion is significant. Alphabet Inc., Google wants to shore up about 15 billion in capital to put some emphasis on their AI infrastructure, which is not necessarily a good thing for a lot of things in the economy. We've already seen a lot of impact that some of these AI data centers are having on jobs moving forward. But that much money in the bond market, negative pressure on interest rates, is not a good thing. Other things to look out for this week. Well, everything important is hindered by the government shutdown. So what can we look forward to? We got some, more PMI data coming out. We're going to be able to talk about the some job openings information. We should get JOLTS data on Tuesday. Everything that Powell said at the presser was basically, as it relates to jobs, we know what they look like. They don't have the nitty gritty data that they would like. So they're missing a lot of data points, but there are other data points, from the Beige Book to ADP, and, they can see the number of claims, on a statewide basis. So they know that jobs, from what Powell is saying, they're low, but there's not like a huge trail off right now. The previous BLS data that we had on, jobs reports and unemployment was showing that jobs are shrinking pretty quickly. And therein lies the problem. We have inflation holding steady, and we have jobs that are mediocre but flat, according to Powell. That's not going to lead to any significant changes in the market. What we need is the government to open back up and give us that BLS data. You can't spell BS without BLS, but we'll take the data. We need it because bond traders are moving on it. Crude oil has been interesting as well. We're getting inventory numbers on Wednesday. Price of oil has been going up, which is putting some negative pressure on rates as well. But overall, until the government opens back up, we're not expecting anything but a lot of speeches and, having to read into those. With the speeches this week, we got Williams, Barr, Hammack, Waller, Paulson. I'm expecting a couple more members of the Fed to be dovish on looking forward on interest rates. All the hawkish commentary last week was not good. And honestly, I feel like the markets don't necessarily believe it. We're still looking at some pretty strong projections for the Fed funds rate on December 10th meeting. So let's fast forward and take a look at what that looks like on our aggregated chart here. This has been as high as in the 90s, like mid 90s. Now we're all the way down to 67.5. We're still leaning towards a rate drop in December. And, I feel like no matter what, we're going to have one by the end of January anyway. I mean, that's at 98.5% right now. I don't know that it matters a whole lot whether it's December or January, but I feel like looking at what has happened to interest rates in the real estate market as we get into that 2-week period prior to a Fed meeting, we've had some of the most aggressive and best rates we've seen. Every one of these, quarter point drops has led to a 10-year treasury dropping, close to that amount or better. Unfortunately, we popped way back up. The 10-year treasury had been holding just around 4.0% or a little bit under. We're at 411 right now with all these outside factors. We really need to get into that 380s and 390s and establish that lower floor to open up to get interest rates where they're going to make a bigger impact. As soon as we get 30-year fixed overnight interest rates in the 5s and holding, we're going to start to see some things move nicely in the real estate side, on the real estate market. And we just keep getting a little further and further away from that. So let's talk about where interest rates are right now and what they've been doing. You see that big jump? Looks a lot like the big jump beforehand. You can see these two low points right before the Fed meets, and then boom, it's up. We settled down just a hair from the absolute top. We're at 6.28% on the overnight average. But I mean, this is like clockwork. We're seeing it get low before Fed meets, pop back up, trickle down. And unfortunately, you look at before the last Fed meeting when we dropped to 4.25 on the overnight average, we hit just about those same levels and then popped up again. So we've seen 2 rate drops right now with interest rates not resulting in anything lower. That's not what we need. We need to be dropping further and then, get a little pop up afterwards. It's fine. I think when we get this next rate drop, whether it's December 10th or the end of January, I do think it'll be December 10th. We're going to have, by that point, you got to figure the government's open by then. We'll have a lot more data sets. And I think the combination of data and, stopping the interest rate drops for a while, looking at that chart after that next drop, we've got a little bit of a pause and maybe only 1 to 2 more drops left through the end of 2026 before we hit that balance point where the Fed feels like inflation can come down, jobs should be able to stabilize, and we should be, in that kind of happy zone for a little bit. But we don't know when that's going to be. We don't know how exactly things are going to shake out when we're getting there. Without data, in a data-dependent world, it's just speeches and it's just conjecture. And things like Alphabet issuing $15 billion in bond sales are going to move the market in a really nasty way when we should have benefited from the PMI data. But relying on data like PMI to move the needle for us, it's just not going to be a successful long-term strategy. We got to get into the good stuff. And, if something happens and the government opens up early this week, and Thursday's a great day, we're going to have a lot of good stuff. For everyone who's an industry insider, real estate agent, mortgage broker like myself, lock it if you like it. This boost, this pump, we're still in a world where things are very tricky to estimate where we're going to be in the future. There's not a lot of long-term prognosis here on where things are going. We definitely can't say as we get into December that we should see some pretty good drops along November. With that data, we just don't know. So we're still in a good spot, hovering around the 50-day moving average. There is room to improve. Today, it's a red day. It's not looking good. That doesn't mean to hold and float. There's nothing coming on the horizon right now until we know when we're going to get some more data that can make us say, hey, hold and float. If you got it, it's good. Take it, move on, and hopefully we have some more data for you next week. For now, we'll see you then. Go do some good stuff.